The global capital markets had quite a roller coaster ride in the quarter, with Trump tariffs creating one of the greatest uncertainty shocks we've ever seen. And then markets steadily looked through their impact and climbed a wall of worry in surprisingly short order. After all this, the GREIT market ended the quarter up about 2.5%, and our fund performed about in line with that. Our fund delivered a solid return over the past fiscal year through June, up about 9%, and continued to outperform the universe of GREITs, adding to our stellar since inception relative performance of about 600 basis points annualized, or cumulatively 40 percentage points. How is the portfolio positioned? The portfolio only invests in the best 10 to 20 real estate opportunities we see globally. We see particularly attractive value in markets like Canada and Europe today, which trade around all-time low relative valuations compared to the US. We also see really attractive opportunities in non-traditional real estate sectors like cold storage, cell towers, billboards, and life science. Companies in these sectors trade at really undemanding valuations, having fairly recently been high flyers in the real estate sector, but they've had a real fall from grace more recently. And we think expectations are pretty washed out for a number of companies in these sectors. That said, we also have large positions in the data center and healthcare sectors, which are posting the best growth prospects among real estate companies globally. To show you some high-level information on our portfolio positioning today, you can see in this page that we hold just 20 stocks in the portfolio with an attractive dividend yield of 4.8%, very strong forecasted growth of 3.8% per year. That's unlevered operating income. We have modest leverage of 36% total liabilities to total assets, a very attractive implied cap rate on the real estate assets of 7.6%, and a significant discount to private market values, or NAV, of 18%. We also see a large discount to our primary valuation metric, what we call intrinsic value, of 11%, which is derived from our capital market-based discounted cash flow model that values companies as going concerns. We underwrite to an attractive 15% annualized return for this portfolio on a 3-year hold as well, reflecting the high in-place yields and growth for the companies in the portfolio. And please also note that especially on our key valuation metrics of intrinsic value and expected return, the portfolio is far more attractive than the universe of GREITs, represented by the FTSE index in the middle of this page. On the right, you can see the country and sector exposures, and I'd especially note the high level of diversification across unique property sectors. How has the position changed? The most material change we made in the quarter was to add some risk and U.S. exposure back into the portfolio in the immediate aftermath of Trump's Liberation Day tariff announcements. The U.S. pretty sharply underperformed at that time. We did that by adding a life science office REIT to the portfolio. This sector once traded at a material premium to the beleaguered traditional office sector, but now trades at a wide discount. It's not totally unjustified. There's higher levels of supply of life science, there's some policy headwinds, and leasing activity has been a little bit weaker in the sector lately. But we think the factors that make life science special in the US, like deep access to capital and talent, low taxes, and a large or wealthy addressable market, will ultimately endure. And as supply winds down in the sector, pricing power will return to these landlords. We also swapped preferences in Japan, continental Europe, small caps, and Canadian retail. And we also notably took advantage of an overhyped concern in a U.S. healthcare REIT's tenant profile, adding a new company to the portfolio there. Reasons to invest in the fund? So we have 3 key reasons to invest in the fund, really today. First, REITs are under-owned and trade at undemanding valuation levels compared to equities. Not to mention that real estate or REIT special attributes like attractive income, durable cash flows, falling supply levels, low leverage, and strong operating platforms. All of these factors overlooked for years could come back into heavy favor. Second, the outlook for real estate fundamentals is quite solid, underpinned by several dynamic real estate sectors that are enjoying strong pricing power and limited or declining levels of competitive supply. REITs are also in very strong capital positions and poised to grow their market share compared to private investors. Third, the track record for this fund has been very strong. As you can see on the chart here, not only have we outperformed significantly with cumulative alpha of about 40 percentage points, but we've done so with lower risk than the benchmark and proven our ability to outperform in up and down markets, even with a high conviction concentrated portfolio and over what's been a fairly challenging period of time over the past couple of years. All of this is due to an unrelenting focus on only investing in the best opportunities we see in the global real estate markets. We expect to continue to prove that we can help investors navigate the global markets while retaining the many benefits of including liquid real estate in your portfolios.
This fund update has been prepared by SG Hiscock & Company to provide general information only and is not intended to take the place of professional advice, and it does not take into account the investment objectives, financial situation, or particular needs of any particular person. Equity Trustees is the responsible entity for the fund. Neither SGH Equity Trustees nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as indicator of future performance, and you should obtain a copy of the product disclosure statement before making a decision about whether to invest in this product. Follow the link in the description for the full disclaimer.